All right. So today is Friday, April 26th. For the next probably for half an hour, we're going to go over what's been happening these last few months. And this is the investor quarterly letter number 3. SimplePassiveCashflow.com/investor letter, I think, is the URL where I keep all these things. So 2009, this is sort of a recap of 2019 quarter 1. Where I am at, I'm financially independent today, and I quit my job a couple weeks ago. This is a cool t-shirt that I made for you all. A lot of you guys are computer engineers for some reason, so this code will make a lot of sense to you. And some housekeeping before you get started. You guys can type your messages in the chat box or just speak up. And if you guys are interested in coming with us to Belize, June 25th to 28th, shoot me an email at lane@SimplePassiveCashflow.com. And if you haven't done so yet, join the Huido Pipeline Club to get access to all these events and updates and deals. So this is a chart that I found kind of visually showing the last from trough to peak. They call it the expansion periods. So we are sort of in one of the longest ones, if not going to be the longest one ever, which begs the question, like, when is this all going to end? When is this bull market going to end and all these values are going to retrace? So my theory is that we're going to keep going up and up and up until that black swan event happens. And the black swan, if you guys want a Wikipedia, it's a term for, most swans are white, right? But then once in a while you have this black one come up, and it's like, oh my God, like, what is this thing? So there's a 10-year treasury and the 2-year treasury inverted, and you guys can read more about that here in the post. But supposedly it's supposed to be an indication where there's going to be another recession in the next imminent future, 6 to 18 months away. I just had the guy from Moneyball Trader on the podcast, and he kind of actually made me a little more optimistic on the economy. He said that the 10-2-year treasury is just a simple, it's just saying that the economy has plateaued. Not to say it's going to go back down, but it could be plateauing to go to the next high, for all we know. And he kind of cited this whole China trade deal, which you guys can go back into the podcast. I think it's episode 146 or 7. But definitely a guy I've been following for a while. Definitely away from mainstream media. So I asked it in the Hui Deal Pipeline Club Facebook group. This is that free one that there's a lot of people. You usually have to sign up for the Hui Deal Pipeline Club to get access to that. And the URL for that is SimplePassiveCashflow.com/club. And we usually want to have a call with you guys so I can sort of vet people accordingly, as opposed to just having another free-for-all 1,000, 5,000 plus people group, another group that's uncurated people. So here are kind of the poll results. People, they're talking about interest rates, consumer debt. There's a lot of various black swan events that could happen that can kind of be somebody even said a black swan event is the black swan event. That makes no sense. Another thing that keep in monitoring is, like, what's the U.S. corporate debt. It's definitely getting up there to where the last 2 previous recessions are, 2002, 2008. And here's this neat chart where you took all these black swan events and kind of put it on a likelihood versus impact. So I think a lot of times, we'll freak out about something like, when, wasn't, I think 2 letters ago, I think the big topic at the time was North Korea blowing up Hawaii or America. and now we don't even think about it. You know, very low likelihood of happening. Obviously, very severe impact, but you know, that's an example of, you know, this is how like news happens, and it can kind of fade away. But going more towards, you know, what's actually happening in different asset classes. So here's a chart of different office, industrial, retail, multifamily, and hotel. Obviously, I'm pretty involved in the multifamily area, and I'm trying to learn industrial and retail a little bit better. So cap rates are, for you guys who don't know, are basically how much money you're making off a non-leveraged asset. Another image here of all the cap rates have been trending. Obviously, it's been generally declining. Don't be that bonehead who says, "Oh, look at that green one over there. You know, that one's going up. I'm going to do that." Well, that's hotels, right? That's a discretionary asset class. In good times, it goes really, really high, but in bad times, it gets absolutely killed. That's why, you know, like I think a lot of people are like, well, and I just look at what on this performa, like how much it's going to yield for me, or what the performa, and performa means like, you know, made up stuff, right? Yeah, you might get 20%, 30% a year in a development deal, but you're going to absolutely killed in a recession, where, you know, it's more, what is your risk adjusted return is what the question you should be asking. I'm certainly not a fan of house flipping at this point in time. So this is the cap rate spreads to the treasury yields, which is sort of the interest rates. So this is what I really key in on. A lot of people freak out on interest rates if it's going up or going down. I frankly don't care. Investors don't care, because interest rates, if they go up, the cap rates usually go up, and they're correlated. So if the cap rates go down, the interest rates go down. Well, I don't know which one leads the other, but they kind of dance together. So investors, you're buying a property at a certain cap rate, and then you're paying out a certain interest rate as your debt service, and you're making money off the delta, which is a very small delta. But remember, real estate is all about increase or leveraging. So don't get tricked when a broker tells you that, oh, interest rates are, you know, all-time low, or it's going to go up. You know, yeah, maybe for your primary residence it makes sense, but I would probably say don't buy a primary residence. And you guys can read the big article I wrote on that at SimplePassiveCashflow.com/home. Just good luck telling your spouse to start renting. But that's what I do personally. So some things I look at, indicators, are jobless claims, because to me, that is indicating how the economy is doing. And the economy and what orders are going to be put in are going to be directly impacting the economy. So here's some information on, you know, what jobless claims are and why it's a sort of a leading indicator. This image I borrowed from IMS. They're kind of a paid information, economic data. I'm actually going to probably be subscribing to this for the group Mastermind group to get some more insights out of that. But their belief is that we're not really going to see another 2008 happening. We're probably going to see what's illustrated here as a soft landing. But yeah, I mean, in other news, you know, starting this new group coaching program, it's been kind of a neat ride since starting the podcast here in 2016. And definitely want to thank you all for kind of joining me along the way, or especially if you've been here since the beginning. I mean, you see the kind of the site traffic there. just kind of going steadily up and up and up. So that's kind of cool. I mean, definitely, I like chatting with all you guys. If you guys haven't had a chat with me yet, sign up for the club and then yeah, book a call. See how I can help you. I know a lot of you guys are shy introverts like myself. For some strange reason, we like people to attract, but yeah, book a call and I'll be friendly to you guys. No problem. So here is a list of kind of some of the latest podcasts and articles that I completed. We talked about the Moneyball Trader when I brought Matt on. So Matt's one of my apartment investing buddies, but I brought him on to kind of talk about his investing in Broadway. Definitely a high risk, high reward type of investment. I would not recommend it if you're under $1 million or $2 million net worth, for sure. But something like about like for every 10 musicals you invest in, you're probably going to make money on 2 of them or 1 of them. The rest will be sort of like total losses. Interesting IRS notice here. Just some more clarifications on how do you use the safe harbor on if you're an active, passive investor. And that was one of the reasons why I quit my job. So I can actually, I've been getting so much passive losses in all these syndication deals because they're doing cost segs on them and getting bonus depreciation. If you don't know what a cost seg is, go to simplepassivecashflow.com/cost seg, SEG, abbreviated there. And you can learn all about there. Some of these deals, like, if you put in 100 grand, I'm seeing anywhere from 70 to 85% coming back in year 1 depreciation. So with that, what you're able to do is, 2017, I made like 100 grand at my day job, and I was able to offset $25,000 from that. So I only paid like 14 grand in taxes, which is ridiculous after it's all said and done. And that was all the passive losses from all these passive investments. I don't know why house flippers flip houses. I mean, I love house flippers. They pay all my taxes for me for some roundabout way. So that's if you guys want more information on tax stuff, simplepassivecashflow.com/tax is kind of the ultimate resource that I kind of created there. I'm not a CPA, but hey, I'm smarter than some of them. But always use your own professional. If you guys ever need a referral and you're in the investor club, feel free to reach out to me. I'll tell you who I'm using at the time. I usually try not to talk about too much in the Facebook group because sometimes people are good and then they kind of suck after a while, and I don't want to be tied to one person. So that the recommendations always change there. But yeah, I mean, so as I was saying, I have a lot of passive losses now. So me quitting my job, I actually make more money in a way because I'm actually able to take these passive losses. Because I believe if your family's AGI is more than 100, 150,000, you get phased out and you can't really use the passive losses to offset W2 income, active income. But it's not a total loss. You can put it in a bucket and kind of kick it forward indefinitely. So that's cool that you can do that. I finally got probably the biggest article I've been wanting to write for a while in Forbes. You guys can check that out, simplepassivecashflow.com/debt. So you can tell all the people who think you're crazy for taking on more good debt. Hey, it's in Forbes. It must be true, right? I have some fun with this. Like I had an investor meeting and I bought these tiki torches so people wouldn't get bitten by mosquitoes. That's the kind of stuff that I like try and deduct on my taxes. Legitimate business expenses, in my opinion. We'll see what my CPA says, but there's in the ultimate guide, I have a list of all kinds of examples. Not to say that they're legal advice, tax or legal advice, but things that might be useful to your business that you can be able to write off as a real estate investor or a realtor. Yeah, so here's a kind of an excerpt from the ultimate guide to taxes, the difference between capital improvements and maintenance and repair. Just a little nuance there, and the passive activity losses. Any questions on any of that before we move on to some of the news highlights there? Feel free to type it into the news or the chat window as we move along. But so here are some of the news links that I've kind of found that were kind of interesting. ALN is a good stats on apartments, and which is a good stat to use if you're even doing single family homes. Percentages, you can kind of get a view on like where the market is going. Different, but just know like a lot of times they're taking into account the class A stuff, which is not the stuff I particularly invest in, the class B and C. So you gotta use the data, but look at it through a certain lens. I think a lot of people, this Oregon putting in a rent control got a lot of hype there, but I actually thought there was I'm not very pro-government control, but I think this one was a good one. They just, all it was like they said that people can't raise rent 7% in 1 year. I thought that was pretty fair. I mean, we underwrite the deals to like go like 2.5% at most increase per year. I think 3% is like, if you want to go on the Oregon thing, smoking marijuana, I guess it's legal there, but that's just not going to happen, and I don't think that's good underwriting. And so here's an image here of population growth. These are generalities, right? Where migration is going. Not to say in your city, or especially that submarket, that is what it really is. Net migration. There's this article, How to Afford Rent. They're interesting articles, but I really don't think it affects Class B and C mom and pop investors, or I don't think it's really applicable. So here's a chart that I found that's showing how people are moving in with mom and dad more. New owners and new renters. I don't know if that's what it really means, but at the time I thought it was a pretty cool chart. Something just to watch. Something I've always said is, people always ask like, what's the best market to look in? Well, it's a secondary or tertiary market with a robust economy. So what does robust economy mean? Well, it's not like a Detroit. Detroit's mainly automobiles economy. But here's a list of some of the more diversified markets. And then the red ones are some of the least diversified markets. I don't know what kind of rubric they had, but I don't quite believe in Atlanta, Georgia being red or Salt Lake City being green. But yeah, it's all kind of different angles at this. Here is a chart of international money coming in. So what this is showing is if you're investing in one of these areas, you need to get out of there because international money just wants to launder their money there and get it out of the country, especially if it's like China or a lot of Asian countries or a country where there's like negative interest rates. So, I mean, yeah, I guess Atlanta's on here and Charlotte, Rhode Island are kind of gateway cities. That's probably why it's in there. But, like a place like Las Vegas and Phoenix, for example, I always look to stay away from that. Look at Hawaii. I mean, it's such a small area, yet it's like $250 million. For you Hawaiians on the call, this is why you don't invest in Hawaii, because you got all this dumb international money coming in, and you're competing with them. Student housing is kind of going up. This looks very familiar to that hotel chart, where in a good economy, hotels do well, and I think student housing does well. I'm not a big fan of colleges, even though I went and got a master's for some strange reason. I think that at some point, people are going to realize that it's not worth getting a state college degree for $30,000 a year and going into debt, especially if you're getting a psych degree or something like that. And there's going to be other ways you can engineer or construct your own degree by going to like a 2-year college and then going to a bigger university just to get that paper. So I mean, I just look at all these buildings that are being built at campuses, and it's all sports and prestige. I think the student housing thing, I mean, just look at the student loan bubble, right? And that thing is bigger than, I mean, it's huge right now. I think the student housing is something I don't want to invest in, because when that bubble pops, this is going to pop with it. On the contrary, I think senior housing is on the rise. And I recently went into one deal of student housing or senior housing. But I don't think they call it the silver wave. I don't think the silver wave is here quite yet. A lot of the baby boomers are just starting to retire now. So they're another 10, 20 years away from actually really needing an assisted living facility. So yeah, just some more data. Yardi is a good one to kind of, they have consistent monthly reports. You guys can always get it here. I'll always just upload it for you guys into the club drive. Here is a good chart where this is Dallas. So this is what Dallas did in the last few years in terms of rent growth. And this is what really drives the value. And you look at there in 2015, that was unsustainable. Even 2016 was unsustainable. Again, I said it before about 10 minutes ago, I'll underwrite properties to be anywhere from like 1.5% to 2.5% annual rent increases per year. Anything more than that is smoke and crack. That is not, when people say, well, I look at the numbers are not about like, what is the investor splits? Is it 80-20? Is it 8% pref? That is nothing to do with the numbers. The numbers is, what are they using for the annual rent growth per year? And we talk about all this stuff in the group mastermind behind closed doors, and I can kind of say whatever I want, but I'll leave it at there. I don't want to go into it, get me fired up about it. Yeah, just more. Here are the Feds raising rates. Here I say it in a different way. Like, here's the 2019 rent forecast by Yardi. I'm like, no way, Jose. 4.3% in Dallas. That ain't gonna happen. But granted, this is taking into account a lot of A-class rentals too. The A-class rentals, just kind of on the same line as the hotel investments, right? When things are going good, it's going really good. But when it's not. It's going really bad. So the A-class here on this chart is the lifestyle. Yeah, the lifestyle line, the one on the bottom. The class B and C is that they've politically correct labeled that as renter by necessity. They need to rent. So this is a good image on, like, this distinguishing between the two. And what this chart says is before the inflection point before June of 2015 was that the occupancy on the higher end stuff, the luxury stuff, was a little bit higher than the class B and C stuff. Now it's sort of inverted, where the luxury stuff has more vacancies. So if you kind of think about that a little bit, it's simple, but it kind of gets you twisted in the head a little bit. So after 2015, there was sort of an inflection point where enough new luxury units came online, and they only build new units, right? You don't build class B and C. It just doesn't make any sense. That's why nobody does it. So if you're thinking, oh, you're going to go fill a niche, no, nobody does it because it doesn't make any money. So after June 2015, it's sort of saying that it's not to say you're at the top or anything like that, but it's definitely the steam is coming off and it's kind of cooling down a little bit. And this is just kind of, you know, like from 2015 to 2018 was like the golden age in apartments. And this definitely shows it. You're seeing that the average rent's going from $1,350 up to $1,400 plus in a matter of a couple of years. And that's why you're seeing a lot of these deals where there's no forced appreciation done, but they're able to give investors huge returns because it's mostly market driven, right? There's two kinds of appreciation. It's market appreciation, which is by luck, and there's forced appreciation, where you go and you paint the walls, you put in backsplashes, you put in new appliances, and you add value to it, and you get higher rents for that. Oh, here's the new U-Haul report. A lot of people really like this, myself included. For 2018, the U-Haul report, which is a good indicator for Class B and C movement, because Class B and C people are blue-collared, and a lot of times they'll do it yourself. Unless you're a cheap college student just leaving the house, you're probably going to just go in a U-Haul and just do it yourself. The other report out there is called the van line report. Now that's when like you're more of like a white collar worker, and they're just going to move you for you. So it's super simple. I don't really follow that. I mean, you can kind of follow that, but I think the U-Haul report is more applicable. If you haven't joined up for the investor club, go and join. I don't know why you're not doing that. So here's a little bit of personal stuff here. I always follow Tony Robbins' 6 needs. And that's, I'll kind of go through them. And this is how I kind of like gauge myself personally. Every quarter I kind of try and address these 6 needs. So the first one is growth. We went down to Tony Robbins in LA. I took the group down there, and it was a really good time. You guys can check out all the video and the photos on that at SimplePassiveCashflow.com/mastermindTony. We'll probably do it again, probably in the next couple years. And I don't like to go to these too often. It is a long amount of time you have to go to them. But if you guys are interested in, like, he does this priming video, which is a little hokey pokey, but it works. You can download the MP3 right there and kind of give it a try at home. The second need is contribution, which is giving back to others. I kind of got the YouTube channel where I want it to be. So there's a lot of videos on there if you guys like to consume stuff more on video. And you know, the group coaching mastermind is more of a cost-effective program. I try to go away from the one-to-one coaching because I always felt bad. Like for me to do that, I need to charge people a certain amount, and that amount is like pretty close to a good portion of like a down payment on a house, right? Like I'm very against these large real estate education programs where they're going to charge you like 20, 30 grand, where everything out there is on the internet. The group coaching program, yeah, there's a 27-week curated course on there, and then we have bi-weekly calls just like this where you guys get to answer whatever questions. But it's the mastermind of like high-paid professionals on there that's really really is the bread and butter, I think, of that thing. But it's pretty cheap, and that was kind of my way of giving back to others, and you know, putting it in a place where it kind of keeps the riffraff out of there. You know, beware of people who are always on the lookout for CFE, cheap, easy, free. I try and stay away from those kind of people. They're not very fun too. Oh yeah, I was kind of bashing hotels. Why they quoted me in Forbes for that too. So another one is significance, another need. So here I'm going to toot my horn a little bit. We, you know, me and all the other Hui investors, we closed on 101 units in Gulfport, Mississippi, and a 309 unit in El Paso, Texas. Both those are tertiary markets, but there's definitely a story in there. Very good locations, very undervalued. Very excited about those. The other need is uncertainty. So in your life, you need to have a little bit of, you know, things that you could go wrong, right? You got to get out of your comfort zone. I was trying to be a little bit more conscious the way I live life instead of just like running around with my head cut off. So I was trying to play around with like making coffee consciously, which didn't really work out. But if you guys are into that stuff, here's a little video. And you know, when we're in Panama and visiting the coffee farms there, they taught us how to do a Chemex, a proper Chemex. I tried this app that comes with a little monitor that goes on your earlobe that monitors your brain waves. So they didn't want to spend $2,500 for somebody to teach me transcendental meditation. Some of the Hui members have kind of recommended TM to me. The other need is certainty. It's nice to, you know, this is one of the projects that we're working on. Definitely some struggles on it. Had a tough winter. You know, a couple of the units got flooded because of busted pipes. And this is up in Des Moines where it goes like Arctic freeze from time to time. But it's always nice to, you know, see progression. I mean, it's moving a little slower than we like, but it's, you know, it's moving. And it's something we can kind of control our destiny a little bit. Sometimes I just ramble on some thoughts I'm having. So if you guys want to read that later. Another way I get the certainty is I have been doing infinite banking, and here's my guide to infinite banking at SimplePassiveCashflow.com/bank. But a little nuance of, you know, the flex paid off writer. Yeah. So what I do there is I put money in there, and because it's life insurance, you don't get taxed on it. I'm not really doing it for the death payout. I'm trying to just put money in there so I can take right back out, tax-free, penalty-free, and make a little bit of yield in there as I'm waiting for the next syndication deal to roll around. Because the deals are sort of infrequent. I love how the taxes, like I said, you know, I had a lot of passive losses. And when you go into these bigger deals, you get a K1 form. You don't have to mess with all those like 20 or 30 Schedule E itemized deductions. You just get one K1 form per deal. So, you know, here's one I invested 35 grand and I got back $27,000 of year one depreciation that I can use to offset passive income. There's another one, and here's a third one. This one wasn't as strong. Yeah, check out what they do in the cost seg, SimplePassiveCashflow.com/cost seg. If you want to learn more about that. And by the way, I quit my day job, so that was a big thing. I'll be doing another podcast on that in the future. And if you guys are, kind of on the fence, let me know, and then maybe I can provide some insights, or kind of taking the. There's definitely a mental progression of going through that. If you guys want to read my article on that, go to SimplePassiveCashflow.com/quit. That's 2 weeks away from my day job. I mean, maybe I shouldn't tell this to you guys, but man, it's so worth it not having to go to work. The sixth and final need that I'm trying to hit here is love and connection. So it's just nice hearing some of the feedback from some of the folks, and then appreciation. I mean, somebody sent me like a gift card in the mail today. I totally didn't expect that from some person I just talked on the phone a little bit. So yeah, I mean, that's been the coolest thing about doing this whole podcast, is just meeting a bunch of cool people. And now I get to kind of do whatever I like, and I put together stuff, videos like this, and actually people like to listen to it. Some resistance, distractions, barriers, and noise that I've been facing. One of the properties in Huntsville, it took us like forever to close on the property, like several months. And in that time, well, the seller didn't care. So the property occupancy dropped. Put 10% here, but it probably dropped even more than that. But we got one of these rental experts this leasing expert. And I don't know what they were paying their son a gun, but he came out for like 2 weeks and he just killed it. And he got the property pre-leased up to 100%. We had to pay the company like 100% of the first month's lease. But this guy was, like I said, I don't know what they paid this individual because he's just an employee, but man, he was like cranking on it. Maybe he just wanted to get the heck out of Huntsville. Well, Huntsville is kind of a fun place. Here's some things I'm complaining about. We talked about this in like the group mastermind. Like, you see all these deals going off, and they're like airplanes, and a lot of times you wave goodbye, but when you run their numbers and you get the P&Ls and the rent rolls, and you're like, man, that plane left with like a quarter tank of gas. So, and it's kind of funny watching some of these webinars because they always use this catchphrase, I'm so excited. I'm so excited about this deal. Well, I don't care. I'm not an excitement person. Show me the numbers. Numbers don't lie. People do. If you guys are into self-development, I would take a look at this, why people fail blind spots. And this is probably after 1,000 strategy calls with you investors booking a call with me over the last few years. Definitely, like, this is the minority of people I talk to, but these are some things that I see that people do that I know they never get anywhere. And I know because I'll check, and they're in the same place that they never got because, in my opinion, these things, and I'll continue to add to this list, but it's hard. Like, we all have blind spots, myself included, and it's hard to do a self-analysis on yourself. Yeah, I think that's it. I mean, yeah, like, if you guys are interested in more stuff like this, like bi-weekly calls like this where you get to ask whatever, check out the coaching page for one-on-one coaching. But if you want a more cost-effective way to network with other investors that are high net worth and motivated to, go to SimplePassiveCashflow.com/journey. And I will be heading to more things. Probably going to head on a trip to check out a couple of deals. I don't want to say where it is because I'm not allowed to. But I told the mastermind members, because They're not allowed to repeat what I say. But I'll probably go and check out a couple places in the Southeast here in the next few weeks. Is there any questions that anybody had? Feel free to type it into the chat room, the chat box, or go off mute. Any questions? I see somebody typing away. But if not, I am going to go and watch the Avengers right now. I'm super psyched about that. I think Garut's going to be the MVP of the movie. I don't know what that kid's going to pull out. He's going to grow and grow huge or do some big things. But I guess enjoy your guys' weekend, and we'll catch you on another one of these videos in about 3 months' time. All right, we'll talk to you guys later. Bye.